You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Bob, welcome to the show.
Good to be with you, Jim, and it's been an interesting week in the markets.
Heading into Canada Day, the U.S. bond market not looking all that hot. How come?
Well, it got extremely overbought at the end of January. It was a good trend. Had been a good trend and rising. And we wrote a piece called, that was dated January 20th, Ending Action, where in looking at the U.S. bond and looking at particularly what was going on in the European bonds with the yield for the German 10-year note heading down to infinitesimal numbers. So the thinking was if we can get the technicals right on the U.S. bond market, because it sort of sees everything. I have a high regard for bond players, really. And then we came in at the end of the month with some upside exhaustion readings. I think since the bull market started in 1980, that there'd only been about 7 times that you had that kind of a reading. So it was very much overdone, and that confirmed by ending action, we meant the end of the bull market that had run for some time. And then the bond did correct fairly quickly on that, sold off. And so the next step on the global bond market was a piece we put out on April the 9th that noted that the correction in the U.S. bond was severe, or significant, that's a better word, and that it would feed into the European market. Now, at that time, a lot of bond players around the world and analysts were saying that the U.S. would get in line with the exceptional low yield in Germany. We took it as the U.S. market would be better in analyzing technically. And then in April the 9th, that's when we said that the correction in the U.S. bond market would hit the European bond market, and it did its insane best on April 19th. And then you had an absolutely huge increase in European bond yields, more or less technically related, due to the fact that everybody was in the market. So then now you then back into worrying about Greece, and earlier in the month the European bond, there is a bond price that represents most of the bonds in Europe, so it did a little rally on hopes that Greece would be fixed. But we should understand that when a country gets this far offside in its balance sheet and the ability to service debt, that it has to go to the hard hit. So what you have here is every time they defer something, the European bond market rallies. But in the last, earlier in June, you had a nice low for the U.S. bond price, bounced up, and then it came down, and then the last couple of days down, and it's sort of sitting right above the last low. So this is kind of a warning that maybe the U.S. market, if it breaks through, let's call it that way, if it breaks through, that would extend the trend in falling bond prices and rising yields, and then by implication that would at some time get the European bond market. So what it looks like is that the authorities keep pushing off the reconciliation of the absurdity of Greece trying to service its debt. So what is happening, you also look at after early September, there's a seasonal that interest rates can go up, and it's also the seasonal when discoveries of over-leveraged accounts can be found. So there's one other way to look at this, and that's the credit spreads, which narrowed. That's the difference, of course, between high-grade yields and low-grade yields. They narrowed into May and then have turned, and then in the last few weeks have broken out to widening. So this is serious because in 1998, for example, the world then was focused on the European community coming together, and the conclusion was that interest rates, say, for Italy and England would trade the same. So it was narrowing of credit spreads. As a matter of fact, they had it as the Great Convergence. And so here was a sure thing because policymakers wanted to do it. But Mother Nature doesn't accommodate policymakers all the time, so you had this seasonal turn into widening spreads, and that, when we looked at the numbers yesterday, was accomplished, where the serious breakout was made by the 1st of July of 1998. And then if you look back on the record, for May and June, the spreads were going against the particular issues that LTCM was positioned in, and they had a minus 6% return in May, and then, I don't know, minus 8 or something for June. So even before the benchmark credit spread had seriously broken out, it was already costing that fund serious money. So wham, then in August, late August I think it was, is when there was a sudden discovery of a problem in the Russian bond market, and then the whole thing became a crash, and it was a real crash. So it wiped out, and it was the largest hedge fund then, $4.5 billion. But the irony was that it was such a sure thing that senior central banks did lend LTCM money directly, and the Italian central bank got so carried away it even took an equity position. So here was this feeding on each other. The policy was that they would narrow spreads, and they liked the fund that was playing that so much they put their own money into it. So anyways, it turned out to be a pretty good disaster. So here we are again. The whole of the world has been long European bonds on the premise that the central bankers would continue to lower interest rates. So it's very similar, and now you're getting a similar change in credit spread, so it'll be fascinating to watch. So here we are. Let's just see what the next couple of weeks brings on credit spreads and bond prices. But I'll tell you one thing, Jim, it doesn't look good at all, and the market will be a better reporter on what's actually happening rather than what the news media will be saying, and they'll be just mouthing what the policymakers in Europe are saying. So I think it's going to be a very interesting July in the credit market.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, are you expecting to see a crack in the equity markets over the summer?
Well, it's kind of a paired thing, Jim. You have a seasonal tendency for highly speculative moves in equity market to reach a momentum peak in May or June, and we've seen that on some sectors in North America, and also a tendency for the markets outside of New York to set very good highs in May and June, and we've certainly seen that in China. And whoa, that gave the upside exhaustion readings a number of weeks ago, and then wham! I think they were down something like 7% overnight here, maybe even getting a little oversold. So the Chinese speculation ran its course, Hong Kong as well, and Europe market is been in a bit of a downtrend since May. That's using the stocks, so nothing too dramatic there. But where in the past, as with the bubble of 1929 and previous ones, 1873, going way back to the first one, South Sea Bubble, the European and British stock financial markets had a tendency to do the speculative peak in April or May. Actually, I just looked at the number yesterday. For the South Sea Bubble, it was such a sensational thing in 1720 that there's a pretty good record of the quotes there, and their high was June 24th. And so then the history on these great, and these, I'm telling you, really huge financial manias, was the momentum peak or the actual high in May or June, and then dithering around through the summer, and then in September taking the path down. And all of them had forced liquidation in the fall, and the markets essentially cleared their problems by November of each of those years. So then the new thing in town was when New York Stock Exchange became big enough to be noticed, where in 1873 Europe and England peaked in May. The U.S. market got another leg up into September and then failed. And same in 1929, the U.S. market did the September peak. And then in 2007, which really was a classic bubble, that high was in October. So it's close to patterns. So here's the view. The highly speculative outside markets look like they've made a top, and the U.S. market can dither around here for a while, take a run for a high into end of August, early September, and then I think if the credit spreads continue to widen, then we're looking at probably some forced liquidation in the fall, which would also be a classic pattern. So. And then looking at some of the commodities here, the rotation from low commodities in December, January up to a rally we expected into May, that worked out nicely. Base metals did well. Base metal mining stocks did well. Crude did well. Some of the oil stocks did well. And then they had some pretty good momentum. Targets were met, so we said, no, let's get out of here. But the grains never really did quite get with the play, and there was a constant discovery of where drought had been. There was some precipitation coming in, but the last week or so it looks like the grains could want to rally a little. I don't know whether I'd play them or even the agricultural stocks, but at least we're looking for a bit of a rally there. And then of interest, of course, is our precious metal sector, which stagnation continues, and I think that we're in a transition from the old paradigm, which ironically was a new paradigm in the 1960s when some undaunted writers started writing about the inflation that the Federal Reserve was doing, reckless policies, and they started looking for gold to eventually head up. And remember, gold was fixed in U.S. terms until 1974. So then you ended up with that bull market which was driven by the fact that everybody knew the Fed was insane, and this was before they even became reckless, and that their policies were ridiculous. They felt that unless they depreciated the currency, bad things would happen. So the new paradigm for gold was Fed bad, dollar bad, gold good. But then you had estimates, $30,000, $40,000. The more zeros you put in, the greater the belief in your research. But so, anyways, that one blew out in 1980. And in retrospect, when we looked at it, I guess later in the early 90s, and realized that the change on that one was signaled by the gold-silver ratio. So in any bull market for precious metals, silver will outperform gold. And that was the case until, if I remember, it was about 2 weeks before the actual high, January 20th, 1980. Silver started to lag behind, and so that becomes a bit of an indicator. But then later on with modern technical analysis, we looked at it, and the silver-gold ratio really soars, and then with that we look at the momentum, the RSI on the silver-gold ratio, and in 1980 it got to 92. So that was high, and we found later on that on more reasonable market highs, anything like around 80 was a danger signal. So then this brings us to then the next big bull market that ran until 2011, which was, by this time on the old paradigm, that the Fed was evil, they'd trash the dollar, and gold would be good. And that worked till 2011 when the same RSI, the silver-gold ratio, got up to 92. So we published that it was a dangerous level and made the comparisons to what happened to the precious metals after 1980. So that then brings us to here, and we've had a number of trades. There was many times we tried to call a bottom and get long, and then the RSI would get up to, in September of 2012, it got to 84 then, another warning, and then even just a year ago in May it got to 82, it was another warning. So, and then more recently in May it got up to 78, which was also a warning. So we've been trying to find a bottom for the precious metal sector, can't find it, and then this thing's gone flat. So we think that the old paradigm of Fed bad, dollar bad, gold good isn't working anymore, and the new paradigm will be the real price of gold moving up enough to restore profitability to the industry, and then one looks at the gold shares. So the way we look at gold is you own some for insurance, and you don't figure out what its price is. And then if you're trying to if you want to buy gold and try to make money out of it, you're really just playing the currency game in U.S. dollars. And in previous post-bubble contractions, the senior currency becomes chronically strong. So it's just a frustrating game trying to actually make money out of silver or gold. So we are just standing aside on owning silver or gold. We're standing aside on owning the gold stocks or silver stocks until we see the bottoming process really convince us that, hey, it's time to be back in the game. And it's frustrating. It's boring because we like to be there, and eventually, hopefully, we will be.
Bob, thanks a lot for chatting with us, and have a great Canada Day.
You too, and we got a good weather forecast, and it'll be a good time.
Hot times.
Hot times indeed.
My guest has been Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. His website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.